record button on. I also see quite a few clients on today, which is awesome to see. Some people I haven't seen for a while. So thanks for joining. Yeah, so in terms of the format, the slides are going to come in from the right side of my webcam here. So the best way to look at, because there'll be a few words on it as we go. The best way to look at that is in full screen, and also. For the people who've just joined in the last minute or so, please pop those cameras on so I can see your wonderful faces. All righty. Also, before we get stuck into this webinar, I'm just mentioning what we've got coming up. So in just over a week, we've got a webinar talking about ATO debts and payment plans. Now, the reason why we're doing this is because the ATO seem to be getting more challenging when it comes to negotiating payment plans and dealing with debt. And also, there was rules brought in the last 12 months that apply from 1 July 2025, which means that if you've got tax debt with the ATO from 1 July 2025, the interest that is paid on that is actually now not tax deductible. It's eye-opening, the impact of that. It'll mean, depending on your tax rate, it'll be meaning a effective interest rate before tax of like 17%. So it's ridiculous. Anyway, we'll be in that webinar. We'll be going through strategies to deal with that. If it ever pops up, if you don't have any tax debt at the moment, that's a great thing. But do keep that in mind. If you do need payment plans down the track, they can come at a pretty decent cost. So there is a link in the chat box to register for that one if you do want to join. Just a brief introduction to Inspire. So we're an accounting firm based in the Fortitude Valley in Brisbane, but we work with small business owners all around Australia. We're known for our ability to save our clients tax. In fact, we're in the middle of our tax planning season right now, which is where our tax saving tally seems to climb the most. To date, we've saved our clients $37 million and counting, and we're looking to save our client base an additional $5 million, maybe more, in the next couple of months before 30 June. Alrighty, and a brief introduction to me. I mentioned my name is Ben Walker. I kicked off Inspire about 12 and a bit years ago when I was 23 years old. I'm an award-winning chartered accountant with over 17 years experience now, and the author of 2 books, Wealth for Life and It's All Sorted. The one that is actually this topic where we're talking about buying a commercial property, I actually talked to in both of those books, but the one that's more focused on the structuring of it is this one here, It's All Sorted. You can get a copy of that with the QR code or the link. If you are a client though, then please just send us a note if you do want a copy of the book, and we can give you that one at cost. Alrighty, that's the book. And in terms of what we're going to cover today, we're going to be covering the common structures that we use to help clients purchase their own commercial property. We're going to talk about lending options. Now, I'm going to say that I'm not a mortgage broker. I used to be. So what I'm talking about is observations with clients, and obviously not recommending anything here without going and encouraging you to seek advice around lending. Generally when we're working with clients for commercial property purchases, we'll be talking with both the client and the mortgage broker in terms of how to best structure that, especially if clients are using equity, for instance, to purchase the property. We're also going to be talking about self-managed super funds and how it works purchasing commercial property through there, because it can be quite helpful for a number of reasons, and also some case studies, which are mostly superannuation based or self-managed super, because again, that's where we find that lots of clients prefer commercial property purchases. As I mentioned earlier, any questions you've got along the way, pop in the chat box, and we can even, we've got some Q&A time right at the end as well. What do I love, particularly self-managed super as well? So personally, I've been an SMSF member since 2011. Those years seem to tick away. I've looked after more than like hundreds of SMSFs over my career. In particular, it was quite odd. When I started at KPMG in accounting, I was put in a team where we were doing self-managed super fund audits in our downtime. So yeah, I even had exposure right back then when I was straight out of school. I was like 18 years old, working in self-managed super funds. Roughly 60% of Inspire's SMSF's clients hold some sort of property, particularly commercial property. But yeah, it's quite a big portion. I'm an advisor on many purchases and also restructures, and about 28% of our clients have a self-managed super fund. So why are we sharing this now? Some businesses' reliance on physical premises. So one of the reasons why our clients tend to buy their commercial property is because they want continuity, and they want to know that they're in charge of renewals, particularly when it comes to businesses where the cost to move would be extreme. So we've got some manufacturing clients where the cost to move their premises from one to another would be hundreds of thousands of dollars, and they want to lock that down and make sure that that's not a risk to the business. And then the other thing is, I feel like even over the last few years, the opportunity for commercial property purchases have just presented, and yeah, it seems like these sort of transactions are more and more common. Now, in terms of when we look at commercial property purchases, I think the first thing we need to do is understand what are our options when it comes to buying commercial premises in terms of what structures can we use. So this sort of table or graph we've got here, we do in different formats for different reasons, but the lens we're looking at here is the commercial property purchase. Now, the things we need to consider is firstly the tax rate. So some people, and there's a case study of someone who purchased commercial property in their own name. But the downside with that is we're dealing with 47% tax rates depending on what the client is earning. The more they earn, because the individual tax rates are marginal, so the more you earn, the higher the tax rate. It can exceed that as well if the individual has HEX debts as well. Now, if we compare that to a company, in a company, you're looking at a 25% tax rate or a 30% tax rate. Now, a 25% tax rate is available for small businesses under 50 million turnover, or certain other companies where they're receiving a proportion of business income and they meet requirements. Generally, if it's just an investment company, if it just owns a commercial property or just owns a residential property or even shares and managed funds, then you're looking at a tax rate of 30%. And that's a flat tax rate. So it's still a lot better than 47%. Then we look at a trust. It says 0% there, but a trust distributes its income to other people or other entities within the family group, and then they pay the tax on behalf of the trust. And lastly, in this last column here, we've got self-managed super funds. So SMSFs have a 15% tax rate as you're growing your balance, or we call it accumulation mode in the super fund, or when you're retired and you're in pension mode, we call it, you're accessing a 0% tax rate. Now, there are requirements for that and also like age requirements and conditions of release and that sort of thing. But generally, we're looking at a 15% tax rate as you're growing your balance and 0% as you're drawing it down. Now, if we have a look at the capital gains tax discount, so most people are familiar with the CGT discount, where if you own an asset for more than 12 months, you get a 50% discount on the capital gain, and then you pay tax on half of the gain. So that applies if it's purchased in your own name. It also applies in a trust, as long as the gain is distributed to an individual. And it also applies in an SMSF, although the discount is not 50%, it's 1/3. And I think that's what they're doing there, is they're taking a 15% tax rate and discounting it by 1/3 to 10%, rather than a weird 7.5%. So that's the goal with that weird percentage. Now, if you purchase a property in a company, then you do not get that 50% discount. Now, if we look at along the bottom, typically we don't buy commercial property in your own name. There's tax and asset protection issues with that. Ordinarily, we don't buy it in a company either. Now, I say we don't. There is exceptions to that, and it's usually with quite high income family groups where they're looking to use a asset purchase in a company to manage Division 7A. Now, I'm talking about quite a few different tax terms here. I won't go too deep on that. It's got a cross here, but sometimes we would purchase in a company. Trust and SMSF are the two most common though. So that's definitely the two main focuses. The other thing as well with an SMSF, you've got to also consider the timing of when you might sell your asset. Now, some clients buy their commercial property almost as a retirement strategy. So they buy it for their business and then they eventually sell their business while still maintaining ownership of the commercial property. And they live off the rental income of the asset there. Now, if you think as you retire and you meet the certain conditions of switching to pension mode and the 0% tax rate in super, what you can effectively do is reduce if you were to sell that commercial property down the track when you've meet those conditions, you could actually pay 0% tax on the gain later on in life. So again, another reason why SMSFs are quite lucrative for commercial property purchases is because often a commercial property purchase is a long-term view, a long-term held asset by the family when it comes especially to related business ownership. And because of that, we could look to make a very tax beneficial sale at the end of it. Alrighty. So lending options, again, for people who've joined since I mentioned this, I'm not a mortgage broker. I was a few years ago, but I handed back the ticket. So I know a bit about it. That's why I'm going to talking to it. But again, this is not advice. It's just purely pointing out what we see with our clients and what they're able to access when it comes to lending. So if we think of lending outside of super is sort of one category and inside of super or an SMSF is another. So if we think of outside of super, the lending is slightly less complex. And I say that it's quite similar in the process of applying. It's just that it's more known. So there's a lot more lenders that lend outside of super than they do inside of super, for instance. And it's a very, very known process. And more mortgage brokers, for instance, would be able to cover this stuff outside of super. The other one to consider is it's a higher tax outcome. So you're looking at about at least double the tax rate, where even if you purchase in a company and you're paying that 30% investment company tax rate versus inside an SMSF at 15% or less, depending on your circumstances. Also in terms of servicing the loan. So again, when you go for a loan, the bank wants to see that you can actually repay it. Now, things that they generally consider when you're going for commercial property is what's the rent that it might bring in, even if it's from your own business. And they would want to see if you're going to own or occupy that property, that you've actually got the profit to be able to pay that rent. And then the other thing, so they will also consider other business income or personal income in most cases to also service that. So and you can also, the other thing we've seen as well is that if you're paying rent to a third party and you intend to purchase a business for owner occupier, then they will consider the rent you're already paying as well. And they may add that back in terms of their assessment to be able to see if you can pay the rent for this purchase that you're looking at. The other benefit of buying a commercial property outside of super is that often you can use other equity that you've got in other properties as security or even as a deposit. Now, even though, like I say, that's one benefit outside of super, we can't do that inside of super. So let's say you've got $500,000 of equity in your family home. You can't go and use that as a security to purchase a property in your self-managed super fund, for instance. So it doesn't work like that, but it's often quite easy to do with commercial property purchased, even in a trust, as an example. Now, I'm not saying that that it's impossible to use the equity in your home if you were to purchase it in the super, but the way you might have to do this, and again, this is not advice, given we're playing with, debt and wealth creation here. But some clients choose to access equity in their home, take a loan against it, and use that cash to contribute as members of the super fund to get the money into the super as their deposit. Now, keep in mind, you've obviously got to pay that debt back on your home. And you can't, depending on your circumstances, you may not be able to take money back out of your super fund to repay. So you may have to have another strategy to repay that debt in that instance. So yeah, and I know I feel like I'm getting a bit complex here, but I do hope that makes sense. That's one of the big things though. If you've got equity outside super, we can't go and use it as cross collateralization for an SMSF purchase. If we look at inside super, I've got in brackets here, or in whatever they're called, apostrophe things. We've got LRBA, which is basically an acronym called Limited Recourse Borrowing Arrangements. It's basically it's a requirement because a super fund cannot borrow in its own right. So it's got to have this thing called a bare trust, or it's sometimes called a custodian trust. That sits in between the property and the SMSF itself. In fact, its name is on the contract and the lending docs. So there's bare trust. Now, it's basically paperwork to get around the thing that super funds cannot borrow in their own right. Now, once the loan is repaid, the trust disappears and the ownership ends up with the self-managed super fund. So it's, yeah, again, it's a weird concept, but just a requirement when you're lending inside of super. Now, in terms of how the lenders look at, how you're going to pay the loan, they will also look at your rental income that the property might get, but they're often also looking at what super contributions are the member of the SMSF making. So if you're making your 27.5K per year per person contributions, like your tax deductible contributions each year, now in this financial year, that limit has gone to 30K per person. So if you're making them, there's 60 grand coming into the super fund before the rental income on that property. So again, the banks look at that sort of stuff and assume that if you're able to make that contribution, that should continue in their minds, plus the rental income as well. Now, yeah, again, I've mentioned tax in an SMSF is 15% or 0%, depending on your circumstances. There is also a smaller amount of lenders. So there's two main lenders who look after SMSF purchases. There are more than that. Although, yeah, we often see there's two main ones that our clients end up with because they're very much in that space. And when the big banks got out of it, but they sort of reversed out of their lending. It would have been probably 2017 or 18 or 19. Those years were when big banks like CBA and NAB, they started pulling out. There was still at least two banks that were quite strong in this space. They are typically higher interest rates as well, but I still don't feel like they're ridiculous. I mean, they're not like an ATO debt interest rate of 11%, not tax deductible. But I think we sort of relatively see 7 or 8% when it comes to lending. And again, with interest rates, it's not all about the rate. With banks, they usually price based on risk. So the more deposit you have, the less your interest rate might be, and also things like the postcode it's in make a difference as well. So yeah, I don't think it's wise to necessarily focus just on the rate. Although what I'm trying to say here is that they don't seem ridiculous to me. The other difficulty sometimes with SMSF purchases is that the lender that you're using can require you to get advice. So it can be legal advice. So go to your lawyer and get your lawyer to tell you how daunting the contracts, the loan contracts are. And some even require, although I haven't seen this for a very long time, financial planning. And financial planners hate signing off on that. So yeah, so just keep that in mind, that may be a request. With SMSF's purchases, the lenders typically need a cash deposit, and I'll talk about what that can look like. shortly. And the other thing that you cannot do with SMSF is use borrowed funds to construct something. So you cannot, in an SMSF, buy a block of land and construct a house or a commercial premises on that. But you can, and we see this all the time, especially with the commercial units that are they're usually like a big warehouse looking thing with a mezzanine up the top, and there might be 20 of those units in a that a developers put together. You can buy those off the plan, even though it's being constructed after you sign the contract, as long as it's a single contract. Again, it's one of those weird self-managed super fund rules that should probably be changed to allow, circumstances which you can get around essentially. But yeah, same thing with an apartment or even a house purchase where you're constructing a house. If it's a single contract from a developer and they build the house on it and your land is included in that single contract, you're good to go. Again, one of the weird things about SMSF lending and more the SMSF rules. Now, when it comes to commercial property, if you buy outside of super or inside of super, you can owner occupy with your own commercial premises, with your business. So your business has to be renting if it's in super from your commercial property, and there's no restrictions on your business company or trust renting from your commercial property trust that's separate. There is a requirement though to pay market rate rent, so do keep that in mind, and you need relatively frequent assessments of that, usually every lease renewal. Yeah, in terms of the LVRs or loan to value ratio, I'm going to say that in self-managed super, we see the LVRs go to 80%. There are some industries outside of super where they'll lend up to 100%. As well, but they might take security over the business. So actually we see that with accounting firms, lawyers, certain professional services firms where they'll lend 100%, but take a charge over the assets of the business. So are they really lending 100%, or is that just an interesting way to cash flow a property purchase with zero cash down? So yeah, LVRs are quite good regardless of structure. Now, deposit required. So again, I'll talk to self-managed super here, because again, I feel like often people have, when I sort of show case studies and things I've seen in the past, it becomes easier than it sounds. But with the deposit required, it depends on the lender, postcode, asset type, and the price of what you're looking to purchase. But we definitely do see lenders lend up to 80%, even in SMSFs. And so let's assume we've got a 20% deposit plus stamp duty. That's pretty common. Again, something I haven't seen too recently, but a couple of years ago, it was quite common for lenders to want 10% of the value of the property in cash after settlement. So if you're buying a $1 million property, they'd want 100K left in the fund after it all goes through. Now, the thought process on that, and it's a wise one, is so you're able to pay a couple of months rent, mortgage repayments, but also things like paying body corporate if you've got that, or just bills and things of the super fund that you might get, especially if the commercial property is vacant when you purchase it. Cash flow is definitely something to consider. But again, I haven't seen this 10% requirement for a little while now. So, I had a client who was wanting to buy a commercial office up in the Sunshine Coast. The purchase price was actually just a bit under 200 grand, but let's just use a round figure to save my head with maths. But a 20% deposit on 200K is $40,000. So it's not a heap of money. When we look at stamp duty, again, stamp duty is a state-based tax. So I've just put in brackets Queensland here. It's about 5.5K. And then I've got here other costs. So legals, valuation, setting up the SMSF if it doesn't exist. Ballpark, it's just a guess of 9.5K. So total cost to settle on that is 55 grand. Now, this client did already had an SMSF, but one question I get often is how much do I need in super to set up an SMSF? Now, if you Googled that question, the responses might come back at maybe 200 to 250K. That guideline has existed since I started in accounting 17 years ago. So adjust for inflation, maybe. So 300K maybe in terms of between you and let's say your spouse, if you've got a spouse. What are your total balances in super? Can you go together to make that sort of money? Now that's a general guide, and the way that is answered is generally when you're looking at the fixed costs of running a self-managed super fund, which is generally the accounting fees to keep the records and the audit fee, which is an annual requirement. When you compare that versus the often percentage-based fees for an industry super fund, or just one of the typical ones like Sun Super or the Australian Super Fund, so which are generally percentage-based. So the more money you have, the more that you'll pay. Now, when you're looking at through the lens of a business owner considering a self-managed super fund, the question I ask is, what are you going to be using it for? And in this instance, this person wanted their own commercial premises, and that they needed, call it less than 60K to be able to settle on that property, and so, in terms of the general requirement of 200 to 250K in super to set one up, you don't need that. But what I think you need more is a strategy of why you want an SMSF and what can't you get what access to, whether it's investments or, whatever you want to do, what can't you get in your normal super fund? So if you do want a commercial premises and, it's something that takes 60K, you've only got 60 or 80K in super, then it may make sense to actually do that. Now, again, I wouldn't recommend, you've also got to consider the cost to set it up and to maintain it. And again, I wouldn't encourage people with low balances to set them up. But what I'm saying is it is possible. And also keep in mind that if you're doing your annual contributions, you and your spouse, you've got 30K each financial year to put in as a tax deductible contribution. So that 60K you might start with turns into 120K less the contributions tax the following year, and you grow your balance quite quickly from there. So I hope all that's making sense. I do also want to show an example of adding a zero to the purchase price. So I've gone from 200K to $2 million. So what does a $2 million commercial property look like? Purchase, let's say in super. We've got a 20% deposit. That's assuming the asset qualifies for a 20% deposit, 80% LVR. So you're looking at a 400K cash plus stamp duty. Queensland government doesn't miss you. So you're looking at just shy of 100K on the $2 million mark, and then other costs. I mean, you might need a more comprehensive valuation, set up an SMSF, lawyers' fees, due diligence. May or may not be that, but just putting in some buffer. So total cost to settle on a $2 million property is 510K. Again, keep in mind that the rental income you will bring in plus your normal contributions each year will be able to be used to pay that loan back over time. Alrighty. I am not seeing many questions yet, but so we'll keep moving forward. So what is the process? Well, the first thing to work out is, do you want to buy a commercial property? If so, you can actually go for pre-approval, regardless of whether you're buying the property inside or outside of your SMSF. In fact, even if you're buying it in an SMSF, you don't even need to have set one up. You can actually go to, and again, we use mortgage brokers to facilitate this, but they can go to your lenders and say, like, here's the details of the client, here's their last couple of years of super contributions, plus the ballpark property they're looking at. Can this client purchase it through an SMSF, and you can get pre-approval through super as well. If you're buying through an SMSF, you've got to set that up. And if you're lending on the SMSF through the SMSF as well, we've got to set that bare trust up, because the bare trust is the entity that has to be on the contract. So again, that's very early stage in the buying process. When you're negotiating with the seller, you need that bare trust with its corporate trustee set up before you sign. And what we suggest there is, it says 1 to 2 months lead time. I mean, within about 24 hours, we can have a self-managed super fund set up and a bare trust. The trick is your existing super needs to be rolled over to your new SMSF. Now, the timing there depends on how quickly the ATO process your ABN application, but also how quickly your outgoing super fund processes the docs. And often, they like to be tedious on and hold up the process. Some are worse than others, but we've definitely seen some weird questions being asked to what seems like hold up the process. So we like to say 1 to 2 months to be safe. Now, you've got to think in terms of the logistics of buying a property. You've generally got to pay a deposit, which could be 5% of the value or some other agreed figure. So you've got to fund that somehow. Now, some clients just put a contribution into the SMSF bank account, part of their 30 grand a year, and they use that. But if it needs to be significant, you've got to work out your cash flow there. And yeah, within 1 to 2 months, generally we see the outgoing super fund has rolled over to the SMSF, and that's a bit of a window. But again, if you're pretty set on a commercial property strategy, and you're happy to do that in a self-managed super fund within a 3 to 6 month time frame, to reduce everyone's stress levels, it might just be good to get it set up in advance of needing it 1 to 2 months out of settlement. So yeah, it may be a bit of a smoother process. Now, if we compare that to buying it in a trust or a company, again, we don't have the SMSF rollover issues, so the lead time can be a lot shorter there. So again, 24 hours to set the entity up after your instructions, and then your name's on the contract, and then settlement needs to be the timing of settlement and your finance clause to be discussed with your broker in terms of how soon that can be. Yeah, so the idea there is company trust is a lot shorter lead time because of the lack of third parties being involved. Oh, I've got a couple of questions. Yay. So I'll start with John first. If you don't have enough money in your super, can you take the deposit from an investment property and place that in your super so that you have enough money and buy it through your super fund? So yes, John. So there's nothing apart from the banks need to approve it, but you can lend. If you pull out equity on a property, you can't cross collateralize with a self-managed super fund purchase, but you can loan against a property that's got equity and contribute that. But they're two separate transactions. You can contribute that to your SMSF. So that can happen. Thomas, can you have a trust set up first before the SMSF, then link it when SMSF is good to go? I don't think so, Thomas, because your bare trust needs to reference your self-managed super fund. And if your SMSF doesn't exist when the bare trust is set up, I think it is invalid. I think there's an issue there. Hannah, can you use your existing trust or do you need to set up another? So if you're buying outside of super, you can have a commercial property purchased in an existing trust. But the question we usually ask there is there a reason you'd want to separate that out into a separate one for asset protection or for any other reason? But generally you can have, there's nothing stopping you having 10 properties in a single trust. Apart from, yeah, it's just, there'd be a point where asset protection needs to be considered. Malcolm, if we already own a commercial property in our SMSF outright, but want to borrow to develop the asset, are we allowed to borrow? So no, you can't borrow to construct or develop, unfortunately, Malcolm. And then I don't know that you can even transfer an asset back to a bare trust to fund, what's the word? To lend on the thing as well. So, and that's the other thing with purchasing property in super. So I am aware that there are lenders who offer offset accounts. There weren't for a while, but I was talking to a friend who has that set up in their super fund over the or late last week. Now, the the mistake I've seen people make is they pay down the loan on the super fund as quickly as they can, expecting to be able to redraw against the equity they've created and then use it to purchase another property. Unfortunately, with SMSFs, you can't. And so, if you do have an SMSF loan with an offset account, you could get the same effect, but you're not paying down the loan. You're actually just offsetting the interest on that until you've saved up enough to purchase a second property. Yeah, sorry to spoil that one, Malcolm. Alrighty. Step 3 in the process, find the property, make an offer subject to your conditions that are best discussed with your lawyer and your broker. So finance, due diligence, whatever you need there. And then apply for finance. If accepted, obviously go through to settlement. So yeah, I've already covered at a bit of a high level the LRBA, limited recourse borrowing arrangement with super. So the SMSF cannot borrow direct. A bare trust has to sit in the middle. Now you can, here's another interesting thing. So you can set up a bare trust where the bank lends the money, but if you've got a heap of cash lying around and clients, you might have a bit of cash in your bucket company or your corporate beneficiary, you can actually use that money and essentially become your own bank, lend that to your bare trust for the purchase. Now, I'll give a case study where a client did something similar to that. Basically, the cash flow is pretty cool. The business paid the rent into the SMSF bank account, and the SMSF paid the loan repayment back to the bucket co. So cash went in, cash went out. It was pretty cool. Obviously, you can only do the out bit until the loan is repaid, but it's pretty cool how that works. The other thing as well with SMSF purchases, you don't have to have a loan on an SMSF commercial property purchase. You can pay cash for it if you've got that. You can also split the purchase so that some of the property is purchased in super and some isn't, but you can't have lending in that model. We've got a special type of trust that we set up for that, if that's of interest, but it's great where clients have a fair bit of cash inside and outside. And again, I'm getting complex here, but let's say you bought $1 million property, 500K from super, 500K funded from a trust, let's say. You can actually over time sell small percents of that into your super fund. To do that, you've got to get valuations and everything, but we've had clients over time transfer the balance of the amount owned outside of super into their SMSF. But with that one, you cannot have lending. The last one here is also buying with a suit. So that's a superannuation unrelated investment trust. That's an acronym we use. So if you've got more than one business partners or two or more, and you're 50-50, there's another type of trust we use where you can basically have multiple SMSFs own a property. And that's handy where, let's say you've got a large purchase price. So we had a group of 4 friends wanting to purchase something significant. They thought their budget was about $4 million, but by the time we walked out of the room, the broker is suggesting, based on the structure we provided, we're looking at about a $10 million purchase price that they're able to buy. Again, this is with using SMSFs, and even with that suit structure, we could use money inside of super and money outside of super. The trick, though, is no family group can own more than half of that special type of trust. So no one can have control over it, if that makes sense. Alrighty. John's asked, if you were to buy outside of super, you could sell small percentages each year to your super until it owns the complete amount. So John, that was in reference to this line here. So for that to happen, for your question to happen, you've got to purchase it in a special type of trust. And you can sell units in that special type of trust over to your SMSF over time. Yes. But again, a complex one. That's a great question on stamp duty. I'm not going to do that one off the top of my head. I don't think it gets rid of stamp duty because, again, Queensland, you're taxed on trust transfers, especially when they hold land. So yeah, I don't think it avoids that. It's more so a cash flow thing. Can an SMSF JV with a related party for development purposes? So Malcolm, we've done, what have we done there? Malcolm, where there's a will, there's a way, I usually say. Yeah, it depends on where the cash is coming from, what it's being used for. And so, yeah, if you've got a specific outcome that you're looking for, I'd suggest we'd workshop that one. But yeah, there's definitely ways we've done property development. Again, I'm not sure exactly where you're going with that one, but I'd suggest, yeah, the best thing to do with your question there is workshop it. The other thing is if you do get other business partners, the options tend to be a lot better than just a single family group as well. Alrighty, jumping into our case studies. So we've got a handful of these. So the first one here is the vet from the bush. So this client purchased his vet clinic, the commercial premises, in his own name. So this was the example I gave that's coming up of purchase in his own name. It was worth about 300 grand and he had a loan on that, which was a weird 5-year loan that expires. I've never seen that before. He had about 150K left on that. What we did is the super fund bought it off him. So you can sell a commercial property to your own SMSF. That's an exempted sale asset. You can't do that with anything but market listed shares and commercial property. So he sold it to his SMSF. The SMSF needed a loan. He had just over 150K in super. So the super fund paid out the debt that he had in his own name and owed him basically the other half of the property purchase. So again, this was a client where his rent from his commercial property went from his vet clinic into the SMSF and then repaid that debt over time. So he vendor financed the SMSF loan. Obviously needed the Bear Trust set up. So here's 27.5K, or now it's 30K in terms of the annual contribution limit. I just taken straight back out after the tax adjustment to repay that debt. Another case study. So this was a client who made a pretty decent capital gain within a surprisingly short amount of time. So there was a commercial property owned outside of super. It was worth about $1 million. The client was shifting into retirement and they wanted to move money and assets into super, given the low tax environment. This super fund loaned money from the bank to settle on the purchase. And it wasn't an owner-occupied property. That's a red herring. It doesn't really matter. But the SMSF received rent for a few years at 0% tax given pension mode. They received an offer a few years later for someone to buy it at 1.3 mil. Because the client had met conditions of release, they were retired, they were on the 0% tax rate. So they basically made a 300K gain at 0% tax compared to if they held it outside of super where they would have paid at least 30% tax on the gain. So it saved them potentially over 100 grand there. Another case study, an IT business in Melbourne. So this was a client who was renting and grew through the COVID years. They had an opportunity to buy an owner-occupier commercial premises near their house, about 300K. So this is like a commercial unit. The property needed fit out, which was funded through prepaid rent. Again, this is where I say where there's a will, there's a way. If it's market rate rent, there's nothing stopping the business prepaying a bit to get some cash in the super fund. The fittings and furniture were paid for by the business itself to access the instant asset write-off when it used to be a lot higher than the 20 grand it is now. The client is now paying a similar rent, but to his own SMSF. And again, this transaction was a few years ago, and I haven't seen a valuation yet, but I'm assuming it's gone up since he purchased it. Another case study. So we had a service business in the building and construction industry. They also grew through COVID. They had an existing home office, but it was hitting its limits, and they had a baby on the way. So they wanted a separate commercial premises where the team showed up every day, not in their own house. The client purchased an 800K property at about 75% LVR. Now this is in a suburban main road. I reckon this and he's done some improvements to it. I reckon this property has probably doubled in its value. It needed renos. It was funded from super funds, so funds in cash. So we can't lend money for construction or renos. We've got to use cash. The furniture was paid for by the business for the instant asset write-off. And the client's got an awesome shop front. He's got a second tenancy as well. He sublets. Yeah, it's definitely a success story there. And he's got a super fund that is likely worth well above $1 million net assets. Case study number 5. So we had 4 business partners looking to buy an office space, another Victorian client. They all had SMSFs and they all had about 200 grand. Some had more to put down as a deposit. The property they were looking at was 750K. So that was enough to not have any lending on it. And so we set up a certain type of, it's an ungeared unit trust because there's no borrowing. Each business partner owns 25% of the units in a unit in their SMSF, if that makes sense. And that trust owns that property outright. So again, another example of a way to make that sort of thing happen. Hui. Well, that's a lot of information in the last 50 minutes. But I do have a bit of time if anyone has any further questions on what we've spoken about today. If you are a client working with us, feel free to reach out to the accountant that is your main point of contact if you want to discuss anything here further as well. If you aren't working with us and you want to explore what that looks like, then feel free to book in for an initial chat with one of our accounting team and we can walk through if we might be a good fit and how we work with our clients. And if you do have to take off, that is totally okay, but I'll stay around for a bit more Q&A. So Melissa, once you've paid out the SMSF loan, can you reuse the Bear Trust for another loan and purchase again, or do you need to set up a Bear Trust each time? So a Bear Trust is set up and it describes the asset in which it's the Bear Trust of. So it would disintegrate if there's no better word for that. But you could reuse the corporate trustee. I don't think there's anything stopping that. Thanks, Michael. Thanks, David. John, I am wanting to purchase a commercial property but don't have enough money in super. I want to move it at some point into the super because of tax benefits. What would be the best way to do this? I would like to avoid as much of the bollocks tax that the government take. Okay, so John, a couple of things. So you could buy it outside of super if you've got the deposit through equity. But the other thing to consider is, could you get enough money into super to settle on the property? And that way you don't have to transfer it down the track. And to do that, you'd have to look at, can you access equity through loans and service that to move that money into super? The other, keep in mind as well, if you've got yourself and your spouse, that's 60K a year that can go in as a tax deduction as well. So it can help out your personal tax situation. Depending on what your timeline is to settle as well, let's say you haven't put your 30 grand per person in this financial year, you could put that in today. And then on the 1st of July, 2025, so it's only in just over 2 months from now, you can put another 60K in. So that's 120K in, assuming you and your spouse, as a tax deduction within the next couple of months. So it's pretty cool. Plus your existing super balance. Timeline, oh geez, timeline would be the next 1 to 2 months. We are negotiating right now. Now there is an exception to the contribution rule. Thanks, Shane. So there's 30K per year is a standard rule. With an SMSF, or I think maybe it even applies to non-SMSFs as well, you have to allocate the contribution to a member within 28 days of the fund receiving it. So technically, just after the first week of June, you could put the 30 grand in and we allocate that in the next financial year to the member. We've done that before. It's called a contribution reserve strategy. You basically get the tax deduction this year too. So it's a nice bite of the cherry. Now that's pulling forward next year's contribution. Now there is also, back in 2019, rules changed with that concessional contribution limit, that 27.5K that's now 30. What happened in 2019 is the government said that you can actually, if you don't use the full amount, you can carry your unused balance forward. And John, it might actually be worth looking at what's your maximum that you can put into super if you haven't used all of your previous year's contributions. And you can do that for you and your spouse to see what your, call it your contribution in one hit could be. If you've not contributed a cent, you could be looking at $250,000 in tax deductible contributions that you could put in, in one single year. So it can be very helpful. So yeah, John, I think maybe the best thing to do is to, and I know you're a client, so we might workshop that one offline if you're keen to discuss that further. But yeah, if your ideal outcome is through super, let's see whether that can happen. Awesome. Thanks, John. All righty. Thanks, Laura and Hannah. All right. Well, again, cool to see quite a few people on this morning. If you do have any questions, there's nothing stopping you sending through an email as well. And I hope that has been helpful. I appreciate you all joining. All righty.